Hey folks, we have a very important video today. So first, we're going to discuss what Wall Street doesn't want you to know, but we're also going to discuss the three-step pullback preparation framework for when things maybe don't go your way. So the first thing we have to acknowledge is that Palantir just crushed earnings, and the numbers were excellent. The guidance was strong, the business fundamentals look fantastic, and yet the stock pulled back alongside the broader market. And while this generally causes investors to go into a panic, the truth is that this is natural and any market environment and serves as an important reminder that you should always be prepared for downside risk. So, why the good news doesn't always equal green candles? The market doesn't move in straight lines, even when the underlying businesses are executing flawlessly. There are countless reasons why stocks pull back after positive earnings. Number one, profit taking. So traders who bought the run up into earnings are locking in gains, creating selling pressure regardless of how good the results were. Two, macro headwinds. Broader market concerns, interest rates, economic data, geopolitical tensions can overwhelm positive individual company news. And number three, expectations game. So sometimes great earnings aren't great enough relative to inflated expectations, causing disappointment despite strong absolute performance. So understanding this is really critical. If you panic sell every time a stock pulls back after good news, you're likely going to get destroyed over the long term. Okay, so now we're going to discuss the three-step pullback preparation framework. Step number one, own great assets that you actually have conviction in. So this is the foundation of everything. If you don't truly believe in the long-term thesis of what you own, you will panic sell at the first sign of trouble. And conviction doesn't mean being stubborn or ignoring evidence. It means you've done your homework and you understand why you own something, and short-term price fluctuations don't shake your long-term thesis. So you want to build your portfolio around companies with strong fundamentals, so solid balance sheets, growing revenues, competitive advantages that make sense when you explain them to someone else, and clear growth catalysts. So you should be able to articulate why this company will be worth more in 3 to 5 years, not just hope that the stock goes up. And when you have genuine conviction, pullbacks become opportunities rather than disasters. So you can look at downward price movement and think the thesis hasn't changed, the business is still executing, rather than panicking about short-term volatility. Step number two is you want to buy steady over time. So one of the biggest mistakes investors make is going all in at once, leaving themselves with no dry powder when opportunities arise. So dollar cost averaging solves this problem. The concept is simple. Instead of investing your entire position immediately, you spread purchases over time. This approach provides several advantages. It removes timing pressure, so you don't need to time perfectly the bottom because you're buying at multiple price points. It builds positions during weakness, so when others panic sell and prices drop, you're systematically buying at better prices. Reduces emotional decision making. So having a predetermined plan removes the temptation to make fear-driven or FOMO-driven decisions, and averages your cost basis. So by buying at different prices, you smooth out volatility and reduce the impact of any single purchase at a bad price. So the investors who do well aren't the ones who timed one perfect entry, they're ones who bought consistently when others were scared. And step number three is relax. The market volatility is designed to shake you out. It's designed to make you question your decisions. It is designed to trigger emotional responses that lead to bad trading decisions. And the investors who succeed long term are the ones who can stay calm when everyone else is panicking. And if you've completed steps 1 and 2, you own quality assets with conviction, and you're buying steadily over time, then daily price movements are just noise. Red days become buying opportunities, green days are nice but don't change your strategy. So bottom line, folks, when you see quality names pulling back despite strong earnings, don't interpret it as a sign that something is wrong. Interpret it as the market being the market. Volatile, emotional, and often disconnected from fundamentals in the short term. If you own great assets, buy steadily over time, maintain your composure during volatility, and pullbacks stop being threats and start being opportunities. The market will always test your conviction. Make sure you're prepared. Anyways, that's all for now, folks. And folks, if you got value from this video, remember to like and subscribe for more stock related content and economic news related content.